and people know us. So
right.
unlike when I tell you about a company called XYZ, which you don't know about, then you need to see a credit rating if you're an investor for that. The size of company also matters in Africa. And the larger the companies, the less they value credit rating. And we've seen that. And I think Jeff can attest to that.
Let me hand over to Janet. The thing is, presumably, as a corporate, that XYZ, I go to Janet, I'm looking for 500 million or 300. She will do a whole big credit appraisal on me. That will cost her money, which money she must recover from me. If I come to her already credit rated, doesn't it make her job easier? And that will be the case whether interest rates are 10% or 32%, Janet.
You're spot on. And as I said earlier, it makes that credit evaluation process standardized. Yes. When you walk across the 40 odd banks in Kenya, the premise or the starting point is standard. Then look at other things. And what you find also is that when company XYZ walks into a tier 1, tier 2, 3 bank, then the evaluation is different based on how they perceive it. But if we are saying that I'm coming in, I'm rated under these categories, then the conversation becomes much, much easier. There's also the aspect about, so we've lent you money, we have to do the monitoring and review, right? So if your credit rating is deteriorating, then you know that the pricing within which we are going to review the terms varies. So I think, and again also I think when you look at, say, a local corporate, a global or a GMNC, a global multinational company, when they walk into the banks, the conversation is different. So when their companies are credit rated, then it means that the starting point is standard. The price may not necessarily be the same, but at least you don't have to take, as a bank, I don't have to take 2 months, 3 months of back and forth as you're giving me documents upon documents, what's your strategy, financial statements. Then I tell you, please bring a Tamana on board, something like that. The conversation becomes easier. And if your rating changes, then it's predictable. You know that if your rating deteriorates, then your terms will also move up. If your rating improves, then you can come into the bank and negotiate for your credit terms to be enhanced.
Yeah, go ahead.
So for somebody to raise money in the market, having a guarantee is not a must.
Indeed.
If your company is solid. 2 examples. The last 2 bonds we did, EABL and Kenya Mortgage Finance Company, they came in on the strength of their, EABL came on the strength of the balance sheets, KMRC came on the strength of its shareholders, and really the kind of back support they had. So there was no actual collateralization of that. Why do people ask for guarantees? People ask for guarantees so that they can be sure the principal will be paid back.
Indeed.
And that's what secures the issuance. So ratings, one, is a very good value addition to an issue. And the minute you come out with a good rating, even for me as an investment analyst, I feel a bit more comfortable to start looking at your case. It's a starting point. But if you come bare, you have no rating, you're just walking through the door, you don't have a solid balance sheet, I have to now go in a bit deeper into you. I'll ask many questions. But a good rating gives me some level of confidence. Somebody has looked at you and is extremely...
to start.
Yeah, somewhere to start. So you just don't walk in. So I think that's important. The other thing that ratings help, and I'm speaking now from the equity side, is that companies, even if they're not raising money but are rated, you see better performance of your share price because now you attract investors who appreciate ratings and feel more confident in investing in your company. So it gives you more credibility, as I mentioned earlier, And that helps your company perform from a share price perspective. So I think there are more benefits than that ratings provide, including governance and all these other things that you might not be tangible, but help the company's credibility. Yeah.
Questions, ideas from this side? Okay, James and James. Any other takers? Yes, ma'am. Do you want to? Okay, start there. You are there already. Mr. James Kabuga.
Thank you very much. My name is James Kabuga. I just wanted to maybe jog the minds of the panelists and maybe also the CMA on the question of credit enhancement. If you look at the architecture in our country, we have 47 counties. Governor Derito said that his county was rated. I think it is the only county in this country that was rated, if I'm not wrong.
No, there are 5 others.
There are 5 others.
There are 5 others, yes.
But
she knows. There are 5 others.
My question is, or rather my comment is related to something I was told when I started my career as a banker. And when I joined the bank I was working for, the manager told me that you are now a credit analyst. If you want to bring any credit, any transaction to me, you must answer the question that if you had your own money, would you put in that company? That is the question that I want you to have at the back of your mind. So when you interpret that to our country, every year we put something in the region of 360 billion shillings to our counties, which means that we believe in them. That is how much we believe in the counties, that in actual fact we are going to get a return on our investment because there is an investment. As a government, would it be helpful to think about providing a government guarantee? Instead of giving 360 billion, provide an instrument where the Ministry of Finance gives a guarantee to selected counties, counties that meet the minimum threshold, so that they can go to the market and raise money, raise their 6, 9 billion, 10 billion that they require every year, which means that we would release the money that we give to those counties for other purposes. Do you consider that this is maybe one of the avenues that the government should use, and using the credit rating agencies to be able to give them a framework that they can do this? Maybe even the CMA can chip in on this
question. Mr. James Murigo.
I just want to bring up one point that is cropping up every now and then, the cost of rating. First of all, when you invite Moody's or S&P to come and rate a company in Kenya, you see, they look at the dollar risk. Yet, the company they are looking at will never see a dollar anywhere. It's a shilling risk. So there is already a disconnect that makes that rating pricing becomes too high. And that's why, for example, the GCR came, they introduced the national ratings, which have got more meaning because it's a shilling risk. The company is dealing in shillings. You are giving a shilling risk. It's a national rating, and the price was reasonable. But even because I would like this meeting to appreciate one thing about ratings. It is not even the rating grade you get. It is not that you are going to be able to market it better when you get a good rating. What is more important about rating is the impact the rating has on your business. I'm going to give an example. When working with the GCR, we started a rating on Kampala City. When we went to Kampala City the first year, their balance sheet, everything was upside down. We told them, if you want to get a good rating, this is what you need to do. We stayed there for 4 years. By the time we finished 4 years, the Kampala city had an asset register. They had a register for all their licensees. They had you could estimate exactly how many shillings they are going to get day to day. At the end of the 4th year, we give them a good rating of A. And we had hoped that then they would use the rating to raise money in the market. For us, to our surprise, that good rating, on the day we announced it, there were about 5 institutions that wanted to give them money. So naturally, they never use the rating. What I'm saying here is that the most important thing about the rating process, it helps you to be better. They come and sit with you, they say, this is where we are. If you want to be better, you go take care of this, this and that. When you finish doing that, you get a good rating. And what you're asking CMA today is that when a rating agency has taken a client that far, they have taken care of the loopholes and they are now much better, they have got a good rating. CMA should guarantee them that if you come with a good rating, we will quickly be able to give you an approval, you raise the money. And the whole process, in the long run, the costs are brought down. Thank you.
Yeah, I want to encourage that. You see, we are talking about how to build the culture. I want to presume we are all convinced rating is a really good thing, and it is very helpful, and it makes our company. Are we believe? Please proceed. Anyway.
Yeah, we're all convinced. But
yeah. So how do we get it? How do we build the culture? Proceed.
Yeah. So I think I have some comments. So the first one was in terms of a comment you made about the SME funding in Nigeria. I think it's a very different landscape because they have regulatory nudging, is what we're calling it here, to ensure that they must get ratings. And because of that, they're able to support the local agencies, right, as they do, as the local market grows and is more vibrant. The second thing I think
so
you mentioned...
mandated ratings are creating the market for the thing.
Exactly,
yeah.
But
okay.
They, in certain circumstances,
yes.
Not just for everything.
Indeed.
So it makes sense to the investor, it makes sense to the issuer, they can see the lower cost of funding, because again, they're also paying for that rating in Naira, right, in local currency. But if I'm a Kenyan agency and I want to raise 500 million shillings locally, and I want to get a Moody's rating at $250,000, am I really thinking about what I'm doing for my company? Or do I just want that name? It doesn't make any sense. So unless you're actually going to borrow money outside the country.
So let me ask, why are you preferring the did you say $250,000 rating, yet you could find something far more affordable in the market? Or is it that these investors are insisting on the expensive one?
Two reasons.
I'll come to you, Ike.
Two
yes,
reasons.
proceed.
Number one, these investors would prefer the expensive one, without a doubt. Number two, yeah, that is without a doubt. But number two, you have to understand why you're getting your rating. If I'm an insurance company that just needs a rating to respond to tenders, should I be paying $250,000? You have to think strategically for your business.
Pause there then. I mean, are you preferring these expensive ratings to what is affordable to African entities? Janet, and then Jeff. Or Jeff, you have the mic, start.
I always give ladies first.
Okay. Are you preferring the expensive rating? Ike, is there a mic on your table?
No.
Could somebody take, you have the floor, proceed.
Yes.
No, don't take the mic from her, just proceed, Janet.
Okay. I guess there could be a bias. There could be. Okay. There could be a bias. And the question is then, how do we change that?
That
how
bias.
do we, ensure that the commercial banks, the financial institutions, consider a rating
from local
credit rating agency vis-a-vis Moody's. And as the lady has said, I mean, if I'm borrowing in Kenya shillings, why would I incur $250,000 bill to get a rating? And the conversation may not necessarily be easier.
Absolutely. Ike wants to jump in, then we circle back to Jeff. Yes.
So, I mean, thank you for the conversation.
And the floor is yours. We're coming back to you.
This
Yes.
is, I mean, the conversation we like to have.
Yeah.
So, obviously, there is a bias. I think we need to call a spade a spade. There's usually a bias in terms of preference, but that's where the regulator steps in. I mean, just picking back on what Siva had mentioned, in Nigeria, the regulator steps in to say, yes, we understand you want to use the foreign, but you have to grow local content. So therefore, some institutions, like the Pension Commission in Nigeria, requires you to have local rating agencies, 2 ratings from rating agencies licensed within that market. That way, they're ensuring that there is a play for the local rating agencies to play within that space of, even if you still want to go ahead and obtain the big rating agencies, it is fine. So the idea about the bias is that it exists, and I made a comment earlier in the morning that we as Agustanco, we've been tracking the Kenyan government for the last 3 years, releasing ratings every year, and the one we released this year, we held the rating constant rather than downgrade like the 3 had done, and we got calls from within government asking why was your rating not downgraded similar to the others, and we gave our position. So the idea is that bias still exists, and until we begin to use knowledge to fight the bias, which is where conferences like this become very important, where we educate people to understand that methodologies, yes, they may be a little bit different, but the variation in terms of the methodology and the outcomes are usually not a lot. The difference is maybe 2 notches, 3 notches differential.
So the takeaway being that therefore the regulator might choose the mandated using, rating agencies that are licensed in the in this market. Is that correct, Ike?
They should provide some level playing field and preference for those who are licensed
by them
locally, because Moody's and Fitch are not licensed.
Are not licensed here.
So why not support the local ones that are already licensed here?
Yes, you had another point.
Yeah, so I think that's correct. And I was in Standard Bank in capital markets for a long time. And if
Yes.
we got a local agency,
This same Standard Bank?
yes,
Uh-huh.
we would notch it 4 notches below in South Africa. And each notch was 20 basis points in pricing.
Ah.
So if I get an A from GCR and an A from Moody's, I'm going to notch down GCR. And that will reflect in the pricing. Now, I understand why they do it, because there was a little bit of lack of transparency. So for them, it's riskier to use the African rating. But also they have to then put in the work to read the African methodology. Right? So I think that was the first point on pricing and regulators. Then the second was when he mentioned Safaricom. And when we look at some of the big failures in this market, it's because we were doing name lending. So you would find an entity like Nakumat that had been downgraded to, I think by the end it was a B-, but people preferred it to a AA rated entity that was slightly smaller that they didn't know. So we were doing name lending rather than risk lending, and we were pricing on name rather than on risk. Yeah.
Do we pause there, because these are, they are good. Jeff, respond to this. Are we lending against names? Are we investing against big names?
We certainly are. I mean, yesterday I was talking to, we were discussing about the performance of a Juakali program.
Yes.
A Juakali program, where a bank is lending to this Juakali. The portfolio at risk is, they actually have 100%
Repayment. Yes.
Small people.
Indeed.
Yet if you look at the big book, the big boys are there, name lending. That's a point, yes. And that's the risk we've taken. Now, to the point of Ike and Sylvia about the use of international rating agencies, I think it's just the same mindset we have with the audit firms. I mean, today, when you're audited by Jeff and Otieno auditors, you look at those books and you're not sure. You even have to take them back to the Big Four, right?
To see if
yes. We still have a very a mindset issue. I think that transition has to happen, and it can start by the local investors accepting their local institutions, that these ratings from the local agencies are good and they're working, and we must accept them, and we're ready to invest using those. But if we follow the international investors positions, we will never get out of that trap.
And in the next session, we're going to talk about perhaps how the regulator might nudge. But you, the investors here, how might you, what's a market leader idea? I mean, how might you step further? You know, by the way, I have a Standard Bank story. Back in the day, I'm in IFC, expert in SME lending, and I'm taken to that place, you know, there in Joburg. And I'm looking, this was in Kibaki time, I'm looking at their outstanding portfolio. At that time, I think it was something like $32 billion. And our economy had just reached $15 billion. And I thought, hey, Jameni. Anyway, so how could you be in front?
Let me tell you, Mauritius has done it.
Yes.
The Mauritians have a rating company called Care Ratings.
Yes.
It was the large banks that accepted to use Care Ratings as part of the investment criteria. And today, Care Ratings has become a highly internationally acceptable rating agencies. So we just have to believe in ourselves.
Yes.
And start using it. We have to. But of course, the rating agencies also have to enhance their standards and let them be acceptable and everything, be more transparent.
Victor wants to say how he could help us believe in ourselves and use our own. Proceed.
Yeah, and thank you, the very eloquent Sylvia,
Yes.
has touched on the mandatory regulatory role of making sure companies do credit rating. I diplomatically wanted to avoid that topic today. So
Why?
I'm grateful it didn't come from me,
Yes.
but came from the plenary. I think it's a question of a chicken and an egg.
Yes.
Should the regulator step up fast and, as Jeff says, it softly and gently
Nudge.
nudge regulations in the market?
Yes.
Then we see the companies have a market and then enhance themselves or build capacity and become better? Or should we see the companies come up, become stronger, then the regulator builds up confidence and say, we now have very capable companies in this market that can do credit rating, therefore I can now mandate it in the market. It's a question of a chicken and an egg. So which one should happen first and which one should happen? So if after this meeting, if you can have a side discussion with Ike, he'll tell you they came from a very dark history of having very poor credit rating companies. And some of the ratings that were there were really, really not to standard. Mm-hmm. Until actually even the regulator had to do something. So they have a history. There's a history behind it. And any regulator who hears about that history will also be very cautious about it.
Indeed.
My panelist here, Janet, raised something very interesting, and it's called perceived risk.
Yes.
So are we perceiving the local credit rating companies to be riskier than the foreign credit companies? Yes. Is that perception risk totally uncalled for? No, because of, again, what Sylvia has raised, transparency. We don't see transparency in the methodology that is being used. We don't see these companies coming up and putting it out for public participation. That's a nice word to use nowadays in Kenya.
Mr. Abibola, where are you?
And there's something public participation does.
Can do, yes.
It builds confidence.
It creates legitimacy, yes.
Because if you have pension providers in the room and they actually participate in building up your methodology as a credit rating company, and if you look at the history of Mauritius, that's actually what happened. There was actually a public participation, and the methodology was built by the market themselves, and therefore they owned it.
Uh-huh.
And that is something, again, we don't see here. So you lack confidence by building that, and probably it's something we need to do. Of course, as I said, there's still perceived risk.
Yes.
And the perceived risk, again, is because of capacity building. So you'll find credit rating is a very what do I say, in the financial markets, an unknown space. And many of the financial experts are unable to do a disaggregate what are the main indicators that are being used to do a credit rating. And they don't understand that. If you put CFOs of different companies in this room today and ask them, if you're gonna borrow money, what type of capital raise will affect your credit rating? They might not be able to answer it because they don't know the indicators that affect that.
Of the thing.
Yes.
It seemed to me like Sylvia wanted to jump into this about public participation and so on.
And then hand over the mic.
Yes.
So for the last 10 years, I was at Moody's 10 years, 2014.
Yes.
The regulator has required that we request public participation, even in GCR, even in our local regulations, but people don't actually respond. Nobody responds.
So it seems to me this is a very good point to try and, an action point for Victor in helping develop the market. Clearly, there is a conversation that is not happening between the credit rating agencies and market players so that perceptions about what is the methodology, is it adequate, is it transparent, can be resolved. I want, Janet, go ahead.
Yeah, and perhaps as you talk about the public participation, the engagements, the tier 1 banks are listed companies.
Indeed.
How then does capital markets, in looking at the regulations, bring the players in? Because then they come in as listed companies, but they're also the commercial banks.
Yes.
We have conversations with the credit rating agencies and look at the methodology, looking at the whole aspect around transparency. And if there are enhancements that needs to be done, if there are concerns, reservations in using local credit ratings, those are addressed. It's our market.
Thank you. Look, we do need to, Mr. Shami, you also want to weigh in. These two comments, and then we are going to make an announcement even better, give market direction. Well done. And then Mr. Kavoga, Mr. Murigo, Mr. Owino, get ready. We are moving into the next session shortly. These two comments, and I'll give you each about a minute and a half to wrap up. Yes, sir. Proceed.
Let me start from where he was.
Yes.
And I think you have a better experience. Yes, it's good to have government in this, some of these decisions, but sometimes it works against the good. I think if you look at the Constitution, there is a stipulation there. If you are, you wanted to say something about that?
Well, I will. At T, I'll take Mr. Kafuga aside.
True.
The Constitution says that counties may borrow, but only
With
a treasury guarantee, which, the Constitution also, in terms of the monies that go to counties, is constitutional, that at least 15% of all the taxes that we pay nationally must, by Constitution, go to the counties. So although what you're saying, it's an interesting idea, it would require quite a bit of constitutional tinkering in order to achieve.
Yeah,
Proceed.
but I think the biggest problem is the legacy issues,
Indeed.
because they scare government from coming in the way you expect. But it's a good idea. I think now we are discussing to see how the budget controller can have some leeway in supporting the process.
Indeed.
So that the assurance in terms of repayment is there. I want to support what my sister said here in terms of national, let me say what we are calling participation. Our experience is we ask for views when we are doing regulations. Unless there are activists who really have certain interests, you don't see responses. You only see responses when those regulations are now effective, and now it is law. It is now when everybody stands and says, this was not right. So we will have those challenges. Victor, I think what we need is what he said. We, the people in the industry, must go to the other side and excite the people who should be using these credit ratings to accept to dialogue with us so that we can agree. If we left it to them, they won't move. I want to agree 100% that there is a bias in terms of who should rate. And I agree that we need to sell our own local ratings so that people can see the standard is more or less the same. Please, let's not forget about the issue of costs. We can look at it in a very technical way. In lawmaking process, and Mheshimiwa, you know, the interests can easily confuse the process. We need to find a way to make people understand the cost may not be the issue or it is low enough. Let me stop at that so that we can have.
Thank you very much. Please take about a minute and a half to wrap up. Some wants to weigh in. Proceed. Is it about the cost or how we will build the proceed?
My point is that I like the issue of public participation in terms of getting consensus for people to understand what is happening. But I'm struggling. I remember when we were building the SME rating score, we put together banks, about 45 banks, to try and suggest what are the key variables that they think would impact the performance of an SME on a loan obligations. And we came up with 56 variables. Those 56 included things like how many wives do you have, number of business, there's so many other things. Do you smoke? What religion? But when we settle down to analysis, those factors reduced to only 17 on the basis of the weight of evidence and information value. Statistically, those 17 reduced down to 6, which had significant impact on the predictability of the score. So yes, because the public will not get to the level where they actually get to see what factors have you finally arrived at based on the weight of evidence and information value. So I think there's a challenge there how we manage that process.
One moment, Sam. Can we seek to clarify what I understood Victor actually to be saying? Take a circumstance where, I don't know, is it accredited directors or who CFOs in, for example, commercial banks are sitting in this room, and Metropol is saying, Augusto is saying, this is our rating methodology. This is actually what we do. I think that's what he has in mind, not necessarily my kind of public participation that let's go to Kamukunji, yeah, ati wale munasema waende, not that one. It's proceed, Sam. Yeah. But I mean, is that correct, Victor? Yeah, I think he's talking about a properly facilitated conversation amongst professionals from you, the CRIs, or we, the CRIs, and investment professionals and bankers in this kind of fora to say, look, this is actually what we are using, and to continually expose them. And he is saying, and a good example is Mauritius, that the way they went about it, once they decided to invest, Mauritius also, I think, has roots in India, and then they joined and did with the bank there in Mauritius. Once they were doing that, they invited the banks to see and other players. Yeah.
So I think that is actually already done. It's called a request for comment. So IFO sends it out anytime there's a new criteria. Even if you're to change criteria, the regulator requires you to send it to investors, to issuers, and other stakeholders. But eventually, what we see is we don't get responses.
Let me make a determination, as a good speaker should. which is like this, that the CRAs are making some effort to expose their methodology to those who should be using. Those who, no, that's what I'm hearing the floor saying. Victor and the banks are saying, and the investors are saying, well, we could do better. Therefore, we leave it there, that perhaps FSD, CPF, for example, because you are already partners, and the big bank on the continent should help this conversation to happen, so that, is that a good place to leave it, Sylvia? Yeah, it's a good place to leave it, yeah. So, a minute and a half, please no more, because we've really run out of time,
Yeah.
and just as is,
Thank you, Nderito.
proceed.
So I think we are now supposed to make declarations and sign documents, so I can declare that.
Yes.
FSD Africa has taken up the challenge, and I think we are willing to work with you through the regulator. We need to see why.
Happy Makofi, Jamil.
Yes.
Sorry, where are the claps? In Swahili, sorry, people are proceed, Victor.
So definitely we'll convene a meeting after this to understand how to structure something and to see why are people responding. Is it because they don't even understand what variables are, what indicators are? So yeah, probably we need to start with a capacity building workshop first, even before we do a public participation. Do they understand what they're participating on? When you send them that document, do they just look at it and get a headache because they can't conceive what it is? So we need to go back and find what the problem is. Now, on my closing comment, I think we've said a lot of things today, and probably we need first just to go back to basics. Credit rating, what is it? It's a risk assessment tool. What question does it ask? One simple question: can you meet your obligations? That is the basics of credit rating. It's a risk assessment tool, asks a simple question: can you meet your obligations? And therefore, a robust credit rating process or system needs to provide very clear indicators that the market understands these indicators and owns these indicators and says, these are our indicators. We know what they are. We know what we are looking for. And I think that is just back to the foundations. I think I would do injustice if I close without mentioning about digitalization and automation of the credit rating process.
30 seconds.
Hopefully it will be discussed in the next panel. It is so critical because it brings efficiency. When you talk about cost, you can't run away from digitalization and automation, especially in Africa and in Kenya, where we are seeing a lot of mobile money and digital lending. Yes. Therefore, we need to find a way of introducing this so that it makes the process efficient and more cost effective.
And indeed, even in the earlier session, Leonard asked the same question of the CRAs that they do so. Jeff, so that Janet can have the last word.
I just want to say that the capital markets can actually do more to support the growth of the economy. And I think use of capital market structures, including ratings, is going to be a very key part of that process drive. So I think we need to really, because if you think about it, today if you borrow from a bank, the cost of borrowing is quite expensive when compared to capital markets. So I think we need to encourage ourselves to make use of these tools and to come out and work with partners like FSD to help meet some of the costs, because they're always very able to come to the table to ensure that we get more and more transactions in the market. So the more we get them in, the more success we'll see. And CPF on its part has got a pipeline which is waiting. We just need partners like you to help fund the cost. And we will definitely encourage the use of local agencies to see how to make that happen. Thank you.
Janet.
I have no declaration. But I guess as financial institutions, we have a responsibility and an obligation to our customers to ensure they understand the process and walk them through that journey so that then the next conversation, the next visit to the bank is easier. And I believe, with working with our regulators, whether it's Capital Markets Authority, whether it's Central Bank, there's a role for everybody to play. Thank you.
Thank you. Ladies and gentlemen, please let us appreciate this wonderful panel. One more attempt. Let's appreciate them. Asante sana, please, if we make our way off the stage and I hand over back to Justus. Asante sana. Well done.
Thank you so much for those very insightful discussions. We have sat for very long, isn't it? We need a bit of a break. So let's stand up for a moment, please. Stand up, yes, if you're virtual attendant, you can still stand up wherever you are. I want us to do a very simple exercise. Very simple. Yeah? Please take your pen. Your pen and your piece of the booklet you have. Mtihani lazima tufanye. Are you ready? Please be sure that you're ready, all of you. Okay? Now put the booklet on top of your head. Please make sure you have space where you will write. Because if you're covered like this, then you won't be able to write. Mr. Shama, you need to have a piece of paper. Turn the next, yes, good. Ensure you open a fresh page. Okay? So then you can be able to write. We want to see what you are going to write. Okay? And I want you to write straight line, okay? I want us to write the word rating. Okay? Let's start. R A T. Don't look. I N and G. I'm going to. Sam, are you sure you wrote that without looking? If you did a straight line, please show us so then we see that you did a good job. This is very good. If you know that you are not from the industry and you have not written it properly, we need to give you a whip. Thank you so much. Okay, I think what we need to do is now to go to the next session. Yeah, so we are coming to towards the tail end of the session. For those who did it right, thank you so much. For those who didn't get it quite right, there's always next time, as they say, so you shouldn't worry. Okay, so this afternoon session is one of my most favorite, where you talk about the regulator. And here we are going to assess the regulatory environment in the credit rating market. I'm sure we have made some declarations, so that is going to go to the resolutions. So we want to see and hear what is the regulator going to say, of course, in the discussion together with other market stakeholders. So to help us do that, I can see Alexander is already up on his legs. Please come through for us. Thank him as he comes in. Clap for him, please. Then we have James Kabuga. And then James Murigu. Please clap for them. They need to be motivated as they come through. And then lastly, we have Daniel Warutere from CMA. Clap for him. The regulator also likes being appreciated, isn't it? Yeah, so what will happen is that Daniel will do a small presentation first to give a highlight of capital markets, and then he can take it over to the panel discussion. Daniel, welcome.
Good afternoon. I know probably it's not speaking after such a high-powered panel, and we appreciate the feedback that has come through. Just as I have my presentation on slides, so if it can be projected, I think the better, so that we can move quickly. So, yeah, distinguished participants, I will be speaking to the regulatory environment coming from CMA, and we've had reforms in this space. Just quick highlight, and not only in the Kenyan context, but within the EAC context. So, as we wait for the presentation to be put up, the Capital Markets Authority has a twin mandate. Just for context, the first one is CMA is a regulator, and just like any other regulator, we are expected to oversight the market, and this includes credit rating agencies. Then two, we also promote or facilitate development of capital markets. I think we all appreciate the importance of capital markets, so we have a bigger role in that if the market is not there, probably there would be nothing to oversight. So having said that, we also have an additional mandate, so not only focusing on capital markets, but also commodities markets. Globally, commodities markets are very significant, and they very well, interact with the securities markets. I think we all know about CFDs and other derivatives that come from commodities. And in execution of our mandate, a forum like this one is very important because it's part of investor education and public awareness. We may have all these frameworks and the reforms, but as long as we don't have these communicated to those who are supposed to take them up, then maybe we may not make a lot of progress. So if we can move to the third slide. Maybe no need to emphasize, but I think important to mention that the third one, the next one, the role of capital markets in the economy. And I think what is key and relevant to this session is when we talk about price determination and discovery. So it's always important to ensure that investors get adequate and full disclosure for them to be able to make decisions when it comes to investments. And the role that rating plays in this regard is very key. Then it's the previous one just before that. We have mobilization of savings, and if we don't have transparency within the markets, it becomes very difficult for the capital markets to play their role in terms of mobilizing savings. And once you have savings mobilized, we get capital formation, and we are talking about capital being raised at scale, and then we have new asset classes, and investors will participate in those processes, and this is key to promoting economic development. So, maybe you can move to the slide that we got key factors affecting the current and future development of Kenya's capital markets. Yes. I think one critical factor, and we all appreciate, is macro environment. We may do a lot of things, but as long as, if we are talking about the policies to do with the taxation, and all the other policies within the macro space, then it becomes very difficult for the capital market to operate as expected. And this includes even the laws that have got an impact on capital markets. I know in the previous session we have had a mention of the various laws and how they impact on capital raising, including by county government. Then of course we have the geopolitical environment. The capital markets today, they are interconnected globally, and if we have disruptions in one part of the globe, the impact is felt across, because investors will want to reconsider their portfolios, which are spread across various continents globally. Then I know this ESG, I think, is a big factor, and we've been speaking about it. So what are we doing in our context to ensure that we minimize the impact of climate change? How are corporations coming up with innovative ways in order to ensure that they remain relevant within the space? So those are just some of the few factors, amongst others, that impact on the development of capital markets. But having said that, and the subject being the reforms that we've had within the capital market regulatory space, it's important to highlight the need for these reforms emanates from various factors, key among them ensuring that we have our frameworks here in Kenya aligned to the best international practices. Our investors come from all corners of the globe, and the expectation is that if we are talking about a framework for rating agencies, it should mirror what they know and the frameworks applicable in other markets. Then there's also need to ensure that there's clarity. There are new developments, trends. We have to ensure that our law keeps pace with those developments, new asset classes, and above all, we have technological advancements, and we have to ensure that Kenya is not left behind as far as those advancements are concerned. So now, coming home, the next slide, the Capital Markets Credit Rating Regulations 2023. The next slide. So now, this framework was developed after a lot of consultations, and these discussions commenced after the 2007-08 global financial crisis. And I think you all agree with me that credit rating agencies took a lot of flack, and they were blamed for either could be right or wrong, but they happened to carry part of the blame in terms of what happened. So there were lessons that we picked from that. Before then, we've had a guideline from 2007, and that is what has been replaced with 2023 regulations. So the key essence is aligned to our mandate, and this is on investor protection. As long as investors don't feel sufficiently protected, then there's always going to be a challenge in terms of ensuring that they have the confidence to participate in the markets. But it's always a balancing act. Even as we protect investors, we have to ensure that the issuers are comfortable with the frameworks that we roll out. There are concerns, and my CEO has spoken to this when he made his comment, that the issues to do with even the costs that comes with the requirement to comply with some of these frameworks. And part of the reform ensured that we took that into consideration. So you can move to the slide that speaks to the changes in the domestic credit rating. Yes, that one. So the first significant change was looking at the issue of unsolicited ratings. This has been noted to be a key concern. You're an issuer, you get fined that there's a rating, you may not have had an opportunity of engaging with the rating agency, and probably it's not a reflection, or it doesn't capture all the pertinent developments within that particular company. So this framework seeks to address that issue of unsolicited ratings, and this is by requiring that before a rating agency rates an issuer, they have to get into an agreement with that rating agency. Then the other key development is recognition and oversight of foreign global credit rating agencies. And this also emanates from the reason that we are the regulators in this space, and when we have ratings happening without the knowledge of the regulators, there could be concerns, but even where assume we are talking about a listed issuer, they may have significant reservations, but there would be no mechanism to redress some of those challenges. So when we ensure that those who are licensed elsewhere are recognized within our Kenyan context, then that would help deal with some of the challenges that may arise. Then, as I said, we are shifting from a guideline to a regulation, because guidelines usually, I know it's debatable, but not as firm as regulations when it comes to enforcement and compliance. Then finally, there has been concerns to do with the governance and ethical conduct of CRAs, and this framework ensures that it has captured key areas that rating agencies need to focus on as far as governance and their conduct is concerned. Then on the next slide, we just tried to, the slides will be shared, but I can highlight one or two key developments coming with the new framework. In terms of definition, we have defined some of the terminologies that we consider key. Then for any rating agency that would want to operate within the Kenyan market, the minimum paid up capital is 12 million shillings only. Then key requirements to do with the confidentiality of information obtained during the rating process to be observed by the rating agency, and that is critical. Then one significant addition is introduction of rating committees, so that there's a robust assessment of a rating after the professionals within the firm have done their technical job, requires the committee to sit, and this committee should be constituted of qualified and knowledgeable members who should be able to assign a rating. I have also mentioned about recognition of players who coming from other jurisdictions, and this includes they should produce their license certificate, certified, and then also a letter from the regulator that there's no objection that they would have with them operating within the Kenyan market. So there are various obligations for these rating agencies, and this includes that, and I think Cynthia has mentioned this, the issues to do with monitoring of ratings during the lifetime of the securities rated, unless if the rating has been withdrawn, disclosures appropriate to the public, including definitions, and requirement for submission of information to the authority. And this is critical for the regulator to be able to do its work effectively. Then swiftly moving to the regional level, you see this is East African Community Directives on credit rating agencies. Within the region, we developed frameworks that will help all the countries within the East African community to develop harmonized regulations. And we acknowledge that our market is interconnected, and we would want to adopt standards which are uniform as much as possible. So we have a council directive within the EAC region, and when you look at Article 32 of that directive speaks to the requirements for ratings within the region. And this article is very specific on issuance of regional debt securities. And this is a framework that, although we've had interest from potential issuers, we've not had a successful issue across the region, but helps issuers who want to tap the entire market to only approach one regulator and get approval. And once they get that approval, they can issue securities across the region. So the regulators, we have a mechanism within the framework of coordinating the approval process, and that helps in terms of reducing the costs and the timeline to issuance of securities. So the requirement is that for regional issuances, there should be a valid rating as long as that issue remains outstanding. And where there's no track record, because a rating could be of an issuance and a particular issue, not an issuer who has been in existence, then there has to be, the rating will focus on the project or the performance projections for the envisaged project. So the revenues that will come from that. Then the other focus on that article is that the issuance, for purposes of regional issuance, the rating has to achieve or attain an investment grade. And I think here we are looking at the scale. If you have an issuer who is projecting to issue across the region, this is expected to be of a given, significant scale. And may happen that this is an issuer who is operating across the region. Then, in terms of the code of conduct, the minimum requirement is that the issuer should have a code, and if they don't, then, or the rating agency should adopt the IOSCO Code of Conduct Fundamentals for Credit Rating Agencies. So, on to the last slide. The recent developments, maybe probably not to talk much about this, has been part of the conversation in the course of the day-to-day. The Kenya, of course, we had the Moody's Investor Service on 8th of July 2024 issuing a ratings announcement which downgraded Kenya's rating to CAA1, maintaining a negative outlook, which is similar but lower to the one issued in 2023. Then the National Treasury had engaged the rating agency, clarifying and issued a statement, in fact, to clarify the Kenyan fiscal situation after that rating was issued. Of course, we also witnessed further downgrades from Fitch and S&P coming in quick succession after the Moody's rating. However, I think what is important is that the Kenya shilling has remained stable, and the International Monetary Fund's budgetary support seems to have calmed down the effect of some of those negative sentiments. Then I think within the past 1 year or so, we've had African Union coming out very strongly and calling for the creation of a Pan-African Credit Rating Agency. And without sounding political, I think there has always been a concern that when you look at it from global perspective, there are many countries who have defaulted in the past, but they still managed to come to the market and raise capital. But when there's noise about or negative rating of African countries, then I think the risk perception is taken to be far much higher, even when probably there has been no defaults. So in conclusion, I think from a regulator's perspective, we are encouraged that we have very strong rating agencies who have been licensed to operate in this market and across the region. And we are very hopeful that issuers will make use of the service in order to ensure that we are able to have a robust and much more deeper capital markets within the Kenyan and the East African region. Thank you very much.
Daniel is saying he has done his part. I have to take you through the next session. Please clap for him as he sits down. So now you are here with me. Be very careful. I usually ask very hard questions. Okay, so welcome, discussants. I think it's we are lucky that this is the last session we want to have. And yeah, I need to sit down. Yeah, I need to look more like them so then we can have this discussion together. Yeah, so happy to host you, Mr. Murigo, Alexander, and James. Welcome. I think this being the last session and being a regulatory session, it's very interesting what conversations we're going to have. You being not regulators, but hopefully we will have very insightful discussions. So the first point that we wanted to mention is around developments in compliance and regulatory frameworks in the region. And I know, Mr. Murigo, you are very experienced guru in issues credit rating. Perhaps you can give us a bit of a snapshot of what the region is going through in terms of credit ratings so that the audience can know what's going on in Tanzania, Uganda, Rwanda. You can go to DRC and even South Sudan so that people know that you are really traveled and you know what's happening in the region.
Yeah, thank you. As regards the compliance and regulatory framework in the region, one thing we must accept as far as the rating agencies are concerned, we have had discussions here that have indicated how the other markets have taken up to their rating agencies as a way of assisting the capital market to move forward. I would like to start by saying this. I remember one time, or it is said that one time Coca-Cola was asked who are their competitors, and they said it is not Pepsi Cola. It is the milk vendors, because according to them, it is not that you are selling the soda, but you are targeting the wallet. It is the wallet that makes you a competitor. They see you are a competitor if you are targeting the wallet from which their clients buy their soda. I'm telling the regulators in this area that who is your competitor? The competitor for the regulators in the capital market is the central bank and the banks. Because what they are doing, both of you are chasing the wallet from the investor who is interested in investing in you, and also the issuer who wants to borrow money from you. Now what happens in the market is that issuer is saying, where can I get help, and help quickly when I need it? And the way the two of you respond makes sure where the clients end up. If you look at this market and in the region, the position taken by the banks is so strong that it is not surprising that you find people today are borrowing money even to put up houses from commercial banks. There are some clients who are putting up buildings with overdraft. They borrow, and they are not paying, even building up articles on their overdraft because they are using short-term money to do long-term activities. Why do they go to the banks? Because the competitor called the capital market has not made it easier for them to go for the long-term money. And the question then you ask yourself, what are the issues? I can hear our telling us about the macroeconomic environment. They are relevant, yes. When the interest rates are high, in the central bank is paying 18% for money, then anybody else who is paying below 18, you cannot get that money. But when the rates are down, it creates an opportunity for you to be able to lengthen the term. And the question will be asking, and that's why we thought about this workshop with this. How do we lengthen the term of the Kenyan money so that our long-term investors can have access to it? Because at the end of the day, we are not going to develop this country with short-term money. We will not do that. And one of the things we have been asking ourselves, why don't people come to the capital market to raise money? There could be macroeconomic and structural disadvantages that are there, but at the end of the day, what we want to do, looking at these two competitors, can I walk to CMA in the morning because I have got a good project, and by the end of the week they can give me an answer? Or if I go to the bank in the morning, can I go home in the evening with the same money? It may be short term, it may be expensive, but it's available. And the question we are asking ourselves, how can then the CMA or the capital market improve their act so that it can also respond to that client? And the view we had here, or the view on the rating agency, that CMA has licensed the rating agencies, you have looked at their methodologies, you are satisfied with the way they do it. So you are saying, if the rating agency has looked at you and you come to us, can we be able to give you an answer very quickly? We talked about quality of the data. We ask another question, can CMA also go an extra mile and saying that you rating agencies, I know you work with other players in the market. There are accountants, there are lawyers, like even the central bank does. Can CMA say that you rating agencies, if you are using accounts prepared by accountants, make sure you use the accounts prepared an accountant CMA has accredited. So on that side you are happy. If it's a lawyer who won't work with the CMA, work on rating agencies, can it be done? What we are asking is this: what would CMA want to do to ensure that the work done by the rating agencies, alongside with other players who feed into the rating report, they are satisfied that at the presentation of that report, an answer can come quickly, so that when I come through the CMA door and I want to go to the bank door, at least the CMA can give me an answer quickly. I think that's the question we're asking today. And we want to ensure that, how do we achieve that? Our message was that if CMA works closely with the rating agencies, scrutinize their methodologies even more, work with them and ensure that they are doing the right thing, then we create the confidence in the rating agencies, and we tell client this: if you want to raise money in the capital market, go to the rating agency, start with them. It may not take you 1 year, it may take you a number, like I explained in the case of Kampala. But when the rating agencies are satisfied with you, that you have come this far and they have given you this rating, then jointly we know that this is a good rating, and the CMA can start with it and say, this is the rating given by rating agency, this is an indication of the health, you can go to the market, issue the instruments, and maybe speed up the process.
Thank you.
That is the issue.
Yeah, so so that we can narrow down to the point, from your perspective, very briefly, where are the gaps between the industry and the regulator?
The gaps between the regulator and the industry is that we need, like now we are talking, to be telling in each other, what do you need to do, what do we need to do, so that we can become more useful to our clients. And what we are saying that, I know we have talked about nudging, we are talking about many things, but we are telling CMA, just like we told the banks in the CRB program, it may appear onerous to ask you to make it mandatory. But what I know 100% sure is that the moment companies start getting rated, they start going to capital market and releasing money much more cheaply. They will start appreciating the rating process. Okay. And that when they appreciate the rating process, they will be asking, hey, why didn't we do it earlier? Because that's what the bank are saying. Why didn't we start the bureau earlier? Because it is very useful to us.
Thank you very much. I think that feedback is taken. More collaboration, a bit more coordination between the industry and the regulator. James, I could come to you and ask, there was a mention that Zimbabwe has already made ratings mandatory and a few other countries. From your perspective, what are the key developments across the region that you can identify in terms of regulations within the industry?
Thank you very much. This is working. It's working? Yeah, thank you very much. My name is James Kabuga. I am a finance and management consultant, and I know that those kind of titles don't convey much, and that is the whole intention, so that we can start a conversation to say, what can you consult for us? By way of background, I am a retired banker. I was working for a regional bank called TDB for many years. And then I retired in 2019, and I took up consultancy to continue with my life. And I'm happy to be part of this conversation. And I actually thought that in order to get to the question that you have asked, that I can mention a few things further to the excellent presentation that has been made by Mr. Warutere. And we ask ourselves, because this is important, why do we need regulation of this particular industry? And I want to start by saying that we have heard a lot today about what CRIs do, credit rating agencies. And the bottom line and the emphasis was that their reports provide an opinion on the credit worthiness of companies to enable investors make investment decisions on the one hand, and then to enable entrepreneurs, people who are running companies, raise capital for their businesses, whether it is short-term capital or whether it is long-term capital, which means that the credit rating agencies sit as a bridge between two important players, holders of capital and the people that need capital to deploy in their businesses. And so that bridge, that service that they provide is so important because it is the basis for which a pricing is made. Banks make decisions on pricing depending on the opinion provided by the CRIs. But in order for you to get that opinion, you pay for it. I know that there is what is called unsolicited ratings, but that mainly plays around the sovereigns. But if you are corporate, most likely any rating that you get, you will pay for it. Whenever there is a transaction happening between two people, it is possible that, like they say, that who pays the piper calls the tune. So there is that possibility or a perception that in actual fact you can get the service being provided because there is a fee and so on and so forth. So it's very important that there is a third party, a third eye, whom we call the regulator. Somebody who comes as a referee to be able to call us to order call everybody to order and tell them, if you are going to be providing this service, these are the conditions under which the service should be provided, and that service needs to be transparent, needs to be able to be read across the players. Everybody needs to be able to understand why you have, for example, given a certain rating to a corporate. I think it is important to understand that because there is always, and the CMA CEO is here, will tell you that one of the biggest headaches of regulators is to actually to get acceptance for people to accept to be regulated. Because everybody thinks that regulators come and they are just a nuisance. So it is important to understand why it is good to have regulators, particularly in the industry that we are talking about, because we provide an important service that makes people arrive at certain decisions. But coming down to the rating, it is also good to put some context to where we have come from, and to perhaps mention two events that happened, one in the early 90s, and the other one around 2001, that made it very urgent for involvement of third parties, so-called regulators. And this was something that happened in California, in a county called Orange County. Hardly 2 months after getting an investment grade rating from the top rating agencies in the world, this county collapsed, and they could not pay its debts. And that raised a lot of eyebrows, and I know that those who are in the industry know about this case. And the next one happened 7 years later through Enron, the energy giant that had also been rated to be investment grade, but collapsed one day, and investors lost a lot of money. And that gave some urgency of in the industry for people to start thinking around standardizing, harmonizing, which is one of the things that was touched on by Mr. Arutere, harmonizing the modeling of ratings, so that when we talk about certain scores, they speak the same language, that we know that when you are rated investment grade, you are indeed comparable to another investment grade investor, even in another industry. So this is the historical perspective, and then of course shortly after that, of course, we had the global financial crisis that was based on some of the mistakes that happened in the US housing market, and we all know what that did to the world. Okay. And therefore, what is the work of a regulator? What is it supposed to achieve? One is to bring good conduct and hygiene in the industry, increase transparency in the methodologies that are used And I know that Sam from Coco, who is a guru in this area, spoke very loudly about the methodologies this morning. Secondly, disclosures. That we have to disclose material things in our operations that affect our profitability and so on. Then improving the quality of the rating process. The third one is reducing conflicts of interest between service providers, their customers, and the competitors, and so on. And finally, begin to define penalties.
Okay. So, in your perspective,
yes.
do you think the capital markets regulators across the region are playing those roles you mentioned?
So that's where I was coming to. I thought I would paint that picture.
Okay.
To say that in the region, we have seen the emergence of some form of regulation, either through the capital markets authorities, through the stock exchanges in the region, through the central banks. But I think we are all in agreement that one of the reasons why this industry has remained nascent over the years is purely because of the lack of that connection and the good environment for the instruments that are necessary to help, particularly in approaching the capital markets to be developed. So the answer to your question is that we are not there. I think there is a lot of work to be done. And even to give just an example of this country, Kenya, which is one of the countries with fairly well-developed capital markets, I think the discussions today say volumes about where we are. We have a lot of work to do. We have frameworks to develop. We have collaboration.
Thank you very much for that feedback. Alexander, I know you haven't talked for the last 10 minutes. Perhaps you can go ahead and now speak. Mr. Marubu indicated that banks are competitors to capital markets. I hope banks won't take offense if they fill the room. And James is saying, perhaps we need to look at the regulations. There's a conflict of interest issue that needs to be looked at. He who pays the piper is the one who is calling the tune. Yes, do you agree or do you have a different perspective?
Thank you very much for giving me the chance to speak. Can you hear me now? Yeah, great. Thank you very much. First, about myself, I do a lot of consulting. I've done some work for National Treasury as well. I've done some work for some blue chip clients I will not name. Some of them are in Washington, so they're pretty big. But it's a pleasure to be here and to speak at last. And just before I get to the specific question as well, let me just say what people are not saying. You're all very polite, you're all very nice, you're all very diplomatic. Nobody is speaking plainly. I like to speak very plainly. There are two elephants who are not in the room. Two elephants who are missing in the room. One of them you know very well. Anytime an African country goes overseas to borrow, people think of the DSA. Are you in the good books of that elephant called the IMF? That, to me, is the principal rating in Africa. The second elephant who is not in the room is the National Treasury.
Sorry to indicate National Treasury is in the room. They actually have joined in virtually.
Are they coming? Oh, NT in the room. Welcome, buddy.
They have joined virtually, so they are listening.
Okay. National Treasury, being the sovereign, everybody is rated off that person. And just as a slight joke to my fellow panelists, 2 weeks ago, Moody's downrated TDB because of exposure to that guy, the National Treasury. The sovereign in Kenya led to TDB being downgraded because of exposure to the sovereign. So the sovereign is not in the room. And why am I mentioning that second elephant is not in the room? Because he has got 3 steps that he's missing. One was mentioned today. He doesn't do accrual accounting, so he has no data. His accounting records are 12 months, 18 months behind. There is no single source of the Kenyan truth on public debt for that sovereign. And just before you don't believe me, Senegal has just done a similar audit of the debt. The new leader just announced the results. Senegal owes twice what they thought they owed. They owed twice the debt. And you can imagine the capital markets being told, oh, Mr. Wino owes twice what we thought he told us last time. So that's the first thing. That elephant in the room does not have data, or accurate data, timely data, correct data. Secondly, that elephant in the room does not have independent fiscal institutions to advise him.
Be careful, the elephant is going to speak.
Don't worry, don't worry. In fact, I believe sometimes they fear me, so don't worry. I'm quoting a certain minister, Ali was a colleague. Then the third thing, it doesn't have fiscal rules. And if I was to use some word in Kalenjin, it starts with Gai, but I'll give you the English expression. It is better to die of debt than to die of poverty, was that expression by that person. And his earlier counterpart had said, so long as I use other people's money, there's no problem. It's other people's money. So it plays with the attitude of that sovereign, that elephant in the room. Beyond that, I really want to help the room here understand rating is a 3-step process. I really want CRAs to focus on the economics of the economy of Kenya. Then focus on our finances, the finances of that sovereign, of which we are all rated, whether you're a corporate or even down towards the SME, or even if you are a regional body like TDB. Then the last thing is that person must be able to discharge his duty as the ultimate regulator. CMA, I like you, but your ultimate regulator of the financial system is that same elephant I talked about, and he's not doing his work. 8 years ago, I wanted to develop the capital markets. I proposed 41 public sector entities that we could corporatize, and then take to the market. Mr. Dundo is here with me from my parasector reform task force report. That elephant did nothing, zero, nada, zilch today. As a result, we only have 454 entities that are listed, 1 or 2 corporate bonds in a decade or 2. There really is nothing happening for a bread maker who wanted to list, and Adunda will give you the name. For people who want to come to the markets. So we don't have that vibrant demand for CRA's work because we only have 54 guys, 1 or 2 bonds in a year. So there's a lot to be done by that elephant in the room. He must do his work. He's the ultimate regulator. With respect to Mr. Shamala and your chairman who are here, you are not the ultimate regulator. That's that guy who is the ultimate regulator. He must do his work because we are all rated off him. Even the regional guy is rated off him. So I really want that message to go clearly to him, and I believe, Mr. Shamala, you had mentioned that sometimes you talk to him, sometimes you talk to him.
I'm not sure whether it's him or her.
You talk to that person, that entity I mentioned. Yeah, that entity, the elephant who is not in the room physically here, must discharge his role. He is the ultimate regulator. He is the ultimate consumer of our CRA output, and he is the person we are rated off. The other day, Mr. Umukoko, about 2-3 months ago, when we were downgraded by the rating agencies, within 2 weeks, they downgrade all my commercial banks. What has Mr. James Mwangi done to be downgraded? Mr. KCB, I think there was NCB and another 4th bank. What have they done? But they're told, because I downgraded that elephant in the room, you must also be downgraded. Through no fault of your own, don't worry about it. So really, I really want that message to come out clearly. A, the ultimate regulator must discharge his role. B, those 41 entities that should have been corporatized and now taken here to the capital markets should be done. That was 10 years ago. It was not done.
and therefore we have no capital market to speak of. We have no bonds being issued. One or two, I think one is, Oduno mentioned one or two are challenges, but if we're issuing 15 a year, we wouldn't even notice one or two, isn't it? But if there are only two, and one has a challenge, then you have a problem. So that really is what I would like to pass over to the room, that there's a lot more work to be done by that elephant. You, Mr. Mukoko, and Mr. Murugu, you're doing a good job, but that person must do his work. That is
Thank you, Mr. Owino. I think they say shooting from the hip. Yeah, that feedback is well taken. The advantage of it all is that the elephant is in the room. It's not outside the room, which is beautiful.
Sure.
Great. So, Mr. Murugu, coming back to you, there was a bit of a mention about how ratings need to be made mandatory, if you like, in order to ensure that this role is effectively played. I think the question I'm still going back to is what is happening in the region, in terms of regulation of rating agencies. You know, if you look at Uganda, Somalia, of course, is coming up. Uganda, Tanzania, the region, Rwanda. Do you have a perspective of what's going on there in terms of regulations?
You see, when you talk about the capital market, whether it's Dar es Salaam, whether it's Rwanda or Kampala, they work very much in tandem with the Nairobi. For example, when it comes to the rating business, the ratings that were being done in the region by GCR was rating companies in all these countries from Nairobi. So the ratings, and Chawanya will confirm this, they are being done from Nairobi. As far as the region, other than what you heard while talking about, that the regulators are coming together to ensure that the rating program is driven on a common front. Okay. There is really not much that is happening because the ratings being done are the one-off by Moody's when someone want to issue money, okay, or the one that are done by GCR. So as far as we are concerned, that the rating process has not taken off. And the question we are asking here today, how do we nudge it to make it more active? Yeah. Because we know that when it becomes active, we will see the results.
Great, so I think...
But I would like to respond to, we can't leave my strategy with talking about the big man. We need to respond a bit. I think it is true the treasury had to do something. Like I had said earlier on, CMA is the advisor to the government. I also said this, the rating is not what rating you get. It's the whole, when you invite the rating agency and you go through it with them, they point to you the issues you are not doing right. And when you do them right, your rating can become much better. The question you are asking here is that I find it not acceptable that we keep on talking and complaining about this animal without engaging them. I think we are saying this from this workshop, because you have the regulators licensed by that person here, we need to engage that treasury as the advisors and tell them it is good to get a good rating. This bad rating is hurting very many people, not just the country, but the entities that my friend is talking about. So it is upon all of us as Kenyans to improve on our government that it is good for Kenya to get a good rating. Yeah. And whatever it takes for us to get a good rating, we need to push for it. We need to make noise that this country needs a good rating because it's good for us. And because we know the things that are making us get a bad rating, we need to keep on engaging. And that's why I asked in the morning, are we just talking to ourselves? Should we be talking to the person who is responsible so that he can benefit from these comments and start working on this so that Kenya can get a good rating?
Yeah, and I think that's a good challenge you are throwing to yourselves, and I think Treasury is ready to be talked to. As I confirmed, they are part of the meeting. Alexander, don't look at me like that. It is the truth that they are part of this session, only that the PS and the CS were out of the country, otherwise they would have attended. But they are in virtually. Great, so going next to James, I think the question of cyber crimes is a key one so far as ratings are concerned, combining the same with technology. And I think there's a question was asked on how technology can be blended into ratings to ensure that some of those ratings come out fast and they are used effectively, combining the same with data. Do you have any comment on what needs to be done from a regional perspective to ensure this is done?
Yeah, very briefly on the question of and somebody talked about digitalization of our operations, and of course linking that to cyber crimes. I think it is very clear that a lot of processes that are undertaken by banks and the other users of ratings, if you remove the human intervention, somehow you get some improvements. And I think there is no disagreement over that. And most of the banks now, when you go, they use digital platforms to actually do their own rating of you as a borrower. Whether you have been rated by anybody else, they will use their own rating platforms to IT platforms by incorporating, inserting certain critical information to determine in which bucket they will place you. On the question of cyber crimes, this is one of the biggest topics now globally, because you know, human beings, being who they are, they always try to be ahead of technology. And we have extremely smart people who are able to penetrate the walls of digital platforms and cause chaos. Even sometimes moving huge amounts of money. And in this country, just about 2 months ago, we read about this, which was very scary. It is possible, I don't know the details, but it is possible that there was an element of cyber crimes involved. So when you are doing ratings of corporates, one of the things that obviously inform you in terms of the risk management of that particular corporate is the extent to which they have been able to digitize their operations so that if there is any hanky-panky happening behind the scenes, the system actually throws out certain information that assists you either to stop or to minimize the damage that the criminals, cyber criminals would visit on you. And of course, the more this, the deeper the investment in this area, the better the outcome in terms of your credit rating.
Thank you very much, James, for that feedback. Alexander, maybe you can combine that with the question of the level to which we have ESG incorporated in ratings as an aspect that is emerging in order to ensure that ratings takes care of some of the emerging issues.
Yeah, thank you very much. I will do the first part. The ESG part is sometimes not very sexy for me. Cybercrime, again speaking very plainly, prepare for more of it, which will cause more damage, which will cost you more money, because cybercrime is increasing as we digitize more. Secondly, cybercrime is now morphing into cybercrime done by state actors and non-state actors. So this is like a huge country like Russia or China or Iran saying, please hack into this guy's bank account. So that cost will increase. Now, how do we mitigate that as the industry? You all know about our digital initiatives in Kenya, but the best example is from India with their digital public infrastructure. They're trying. It doesn't work very well, but they're trying. Just about a month or two ago, India, the RBI, launched what they call a digital lending infrastructure, so that you can lend, if your banks, 40 banks, all lend in 2 minutes, not in two months. So the DPI, the DLI will help. But ultimately, we need digital IDs. We don't have one. I did recommend to that elephant in the room, if he's listening. We need digital ID. We need things like, to be self-sovereign. We need things like, this one is now very complex. It's called DLT, blockchain. That is still nascent, it's still starting. And once that is in process, then we have two monsters in the horizon who are working in called AI. You all know AI. The last thing you want is AI rating Omukoko, isn't it? That's going to happen soon. AI can rate you. And the next thing we have on the horizon is quantum computing. Danger, 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 because that will kill what you know as encryption. So that side I see more risks. And we can do nothing about DLT, about AI, about quantum computing. The ESG part is a simple part. And let me say it gently. Let me say it gently. The E in that ESG is environmental. But from the northern side, it is telling Africa and our corporates, don't touch your oil and gas. Leave it on the ground. Whereas me, Norway, Saudi, America, will drill all my oil, drill, baby, drill. So there's a little kind of like lying on that. So ESG, when you talk about reducing your resource use, that's fine. Reducing your water use, that's fine. Reducing your power use, that's okay. Being more efficient, that's okay. I can buy all that. But when you tell my corporates, when you tell Uganda, our neighbor, don't build that crude oil pipeline while I'm drilling in Alaska to the last barrel, then there's some element of double standards. So the ESG part, I wouldn't stress too much on it. And just in case you don't like what I'm telling you, listen to BlackRock in America. Those had a similar problem with DEI about 6 months ago, and they just said DEI, throw it on the bus. Forget about it. It doesn't matter. So ESG, yes, it's a rating factor, yes. You should minimize resource use, yes. You should be a good citizen in terms of the so-called climate, yes. But I submit to this room and that elephant who is not here, that is not Africa or sub-Saharan Africa's priority. We only do 2% of global emissions, so we do not matter in terms of warming the climate. So any client coming to me, worried about ESG, I'll tell him worry about your profit margins, your market, reaching Wanjiku, distribution network, do not worry about the E. Because Americans, large asset managers, have taken DEI and throw it on the bus.
Okay.
Completely.
We always welcome feedback on all aspects, so that's Alexander telling us what we need to have a view of. We request we conclude.
Just add something to what
I was coming to you shortly, so you will conclude as you make the comment. So then we also are sensitive to time. Thank you. So, Mr. Bruegel, speaking about ESG and cybercrime, even as you conclude, because it's the last time you're making your comments, maybe you can lay out your case to the audience, so then we also conclude.
On ESG, I want to differ slightly with my friend in saying that environment, if you are a factory and you are pouring bad material in Nairobi River, that is not a good ESG. That's not good. What we are saying here is that ESG has got very many good attributes. When we are told to look at the sustainability of your company as part of the rating assessment, how sustainable are you, how you are taking care of your employees, or how you are taking care of the environment, these have nothing to do with anybody else. They are having something to do with yourself and those around you. If you do good things, don't worry about those who are doing bad things to others, but do the best you can in your own environment. So ESG is good. If people are making it look bad, it can be good. It can be bad.
Good. So I'm seeing there are different views here, but it's still okay.
What has happened is that on the rating agencies, ESG is now part of our report on the companies.
Okay.
We want to assess that in wherever they are, how are they responding to the requirements for taking care of the environment, taking care of the company, and taking care that they'll be there tomorrow. Because tomorrow is what we are talking about.
Okay.
When it comes to the mitigating the challenges on cyber crimes, at the end of the day, like we said in the morning, taking care of the IT and systems, it is the first step towards the cyber crimes.
Yeah.
And what we need to do is that, as we are being told that the crime is developing fast, is to make sure that when you set up your IT system and your systems, you are ahead of the game. There are no other ways. Because the crimes will be there, it's only those who are ready who will not be attacked.
Okay. Thank you, Mr. Murigu. I think that is very clearly put out. James, now you can say a few of the points you had, even as you conclude.
Thank you. I wanted to say something about ESG. To say that there is a new thinking now globally that you can run a business and you make profits, which is good because that's why we all go into business. But one of the things that particularly investors want to know is the impact that your business has on the environment. And it all revolves around the climate change discussions. So as you know, the ESG is environment, social responsibility, and the corporate governance practices. If you, for example, want to float a bond in the Nairobi Stock Exchange, and you want to invite, some overseas investors, one of the things they will want to know, and you have to disclose, is the utilization of the funds that you are going to be raising. And once you disclose that, you will find that there are some investors who will say, because of your intended use of the funds and the impact that I think they will have on the environment, I will not invest. And now that forces you as an issuer to only engage in activities that are environmentally friendly, that are socially responsible, the so-called two words, impact investment, and also responsible investment.
Yeah.
So the investor community are now becoming very conscious of these two things, and the community is actually expected to be able to pronounce themselves on what impact the operations will have on the environment. Thank you.
Okay. Thank you so very much. I believe, Alexander, you have a last word?
I think my last word is basically to the room. I've made my case. If it's ESG, I can tell you a very, very simple example. One simple light bulb in California uses more power than the average Wanjiku in Nairobi. So if you really want to worry about the climate, what about that guy burning one bulb in California, not Wanjiku in Kenya, who has to eat? And secondly, I don't mind a company being good, okay? Just like I don't mind Microsoft telling me, I want to do a data center in Kilifi, I shall power that with a nuclear power plant. I'm giving the announcements. They want to power their data centers with nuclear power plants, let's say in Kilifi. Now, is that good for my Wanjiku here when she comes to me for advice? I would say, hell no. You don't have the capacity to manage that fallout, possible fallout. So there are many things we need to do. I will leave my co-panelist, Mr. Murigu, with just one word called K, Kuznets curve. Every country in the last 200 years has had rising emissions, rising use of energy until a peak at $13,000 per capita, and then it falls gradually. We are not there. We're in the rising energy use phase of the curve. per capita is $3,000 or less. So your future is to use more energy, more power. When you reach $13,000, then you can start calling Alex, and Alex, I need to worry about the clean Nairobi River. I need to worry about less emissions. $13,000 is the level of China today. We are not there yet.
Thank you very much. I don't know whether Mr. Muruku has the right of reply.
Kuznets, I say, Kuznets come.
Mr. Muruku, you're okay, right?
Point taken. All I'm saying is that if someone is doing bad, you don't just join them.
Okay.
You do the good thing.
Okay. So with that, we end it there, and thank you so very much, my panelists, for these very insightful discussions we had. We agree that the views are divergent, and that is where we are here to have to listen to all these views, isn't it? Clap for them as they come down.
Thank you, Ben. Oh.
All right, of course, you can engage them after here, so then you can listen into their other perspectives. So we are almost getting the tail end of this session. And it should be time for a brief on the way forward. Nerito, do you want to come and mention something before I call the CMS CEO to mention one or two words, and then we close? Clap for him as he comes to the podium.
Thank you very much indeed. Please appreciate yourselves and all our panelists and speakers. It's been a wonderful, wonderful day. So, way forward. Is that where we are? I think one way forward, this is, please, Mr. Shamia and the rest of the team, you know, I'm doing it on the fly, because where is the rapporteur to bring it up? Number one thing that I think we agreed or was offered was FSD facilitating a conversation between the CRAs. CRA, not to be confused with Commission for Revenue Allocation. We are talking about credit rating agencies, facilitate ongoing technical conversation between them and the other market players so that we build confidence on the rating models. All those in favor say aye. Aye. Resolution number 2, they're not in order. I mean, I'm just saying that our regulator may consider mandated ratings. All those in favor say aye. Aye. Number 3, that the CRAs in the room, I hope somebody is taking, the CRAs in the room, shall I say shall, Abibola? Yes. The CRAs in the room shall collaborate and find a way to work together across the continent. It is better for them, it is better for the market. All those in favor say aye. Aye. So far the ayes have it. Number 4, is it number 4? It is clear there is need for way more market sensitization, and that the CRAs and the regulator jointly do this activity. All those in favor say aye. Aye. Where are we? Number 5, that, you know, what is number 5? Huh? Oh, you're waiting. You're waiting for me. It seems to me that therefore we should consider having this conference as an annual platform, you know, going around the continent, pursuing this agenda. All those in favor say aye. Aye. All those in favor say aye. Aye. The ayes have it. I think that our final resolution is to express our, let me use parliamentary language, that this congregation resolves that our appreciation and thank you be registered to the regulator for being the primary host of this event. All those in favor say aye. Let's have it. Just us.
Nderitu has not asked.
Just say it loud. Say it loud. Maybe I missed it. Say it loud. Let me bring you the mic. Say it loud. Say it loud. In case I missed it.
We resolved to leave at 5. Anyway. I think FSD also resolved that we'll be able to convene a meeting of all stakeholders to understand the methodologies and all that so that we could have some industry acceptance. I think that's all. Those in favor say aye.
And all
Absolutely.
not in favor say nay.
The ayes have it. Mr. Moderator, we did resolve, we did resolve, did we not, that the regulator may consider organizing for us to engage with parliamentarians as well as with the Treasury so that this conversation is also going to the years we needed to go to. All those in favor say aye. Thank you.
Yeah, COCMA wants to speak. He needs to be clapped for, you need to encourage.
No, thank you. Just as I need to thank you for organizing us, I think we are coming to the end of this function. Maybe you need to ask the person who shall be praying to be near here because we need to release ourselves. I want to thank Metropol for insisting. I think it has been a long wait, but I think your leadership in this matter, we really appreciate. We were just having a discussion with Sam. I was telling him, maybe I am the biggest beneficiary because this is what we wish to see. Please, thanks for this engagement. Alexander, thank you. I think we hear your energy. I think we will give you more airtime when we have this discussion so that we can have all those varied views. But let me say this because I am speaking from the position of interacting with the government. The government is very committed. Right from the president to my parent ministry, we have engaged. In fact, were it not that there was commitment that was there, which we all understand and is very necessary, we were meant to have the senior most attend this session, but we understand. We appreciate the representation which is with us. We have agreed that we will try to get this item into the caucus, which is actually picked up at the Nation Treasury, so that we explain the importance of having a good rating for the nation. I think that is something which we take home. So from me, on behalf of CMA and also the very good sponsors and organizers of this event, I want to say thank you. Please, as you travel, we'll do this again. When you see our invitations, know it will be another good discussion at that time. Let me leave you with God's mercies as we prepare to have a closing prayer. Thank you so much.
Thank you very much, Mr. Shamia, for those final remarks. We always appreciate when the regulator is in the room because we assure nothing. You know, a regulator is like the old wazes. They say, penye wazee, bas. Great, so I want to call in my colleague Faith to come and give us a short prayer, and then we will see how we can disperse from here. Faith, please. We may be upstanding so then we can pray.
Let us pray. Dear Heavenly Father, we come before you with thanksgiving in our hearts, O Lord. We thank you for giving us the gift of life. We thank you for giving us the gift of good health. We thank you for gathering us here today. We thank you for the credit rating conference that we've just had. It was indeed a very fruitful engagement and a great learning process. And we pray that you give us the intellect as the stakeholders in the capital market sector to implement all the recommendations that have been cited, to reduce the cost of capital, and we know that all of this will indeed give a positive impact to the economy, O Lord. As we go home, we ask you to please protect all of us, O Lord. Give us journey mercies so that we may arrive home safely and be reunited with our families. We love you and we trust you and we glorify your holy name. And we pray all of this, trusting and believing in Jesus' name. Amen.
Yeah, thank you very much, Faith. Now, 2 announcements before you leave, please. There's something that is supposed to be displayed on the screen. There is a National Credit Market Convention happening on 21st and 22nd of November 2024 at Lake Naivasha Resort. All right? The display on the screens, you can see it. It's happening on 21st and 22nd of November 2024. So you can meet the Metropol team, so then in case you're interested in attending, then you can attend. That's number 1. Number 2, we need to say goodbye to each other. Please make sure you have someone to say, to give a high five to. We are going to do it in style. We are going, make sure you have someone to say high five to. I'll count. 1, 2, 3, let's go. Goodbye and see you next time. For our colleagues who are virtual, see you next time. Thank you so much for attending.